Let's get to another management, Redington. They posted a very good set of numbers in the second quarter. The revenue was up close to around 24%. That was driven by the mobility segment. The EBITDA margin as well has held steady at around 2.8%, but the management has said that tech demand related to work from home has been coming down and that the cost of capital, well, that's gone up, obviously. To discuss this and more, we're joined by Mr. Rajiv Srivastava, the MD of the company. Hi, Mr. Srivastava. Morning. Thanks so much for joining in. Well, something that's impressed clearly in the last few quarters has been holding on to these margins. I recall that in FY19, margins were around 2%, which has moved to around 2.8% odd. Do you believe you can do even better from here on? And also, I wanted a brief number on what percentage of your revenues comes in from consumers and how much of it comes in from enterprises. Go ahead, sir.
Okay. I think it's a great question on how the margins are holding up. Our margins have been very stable over the last couple of quarters. And you would know margins are a function of a few factors. While the gross margins are holding up, obviously there is pressure on inventory, there is pressure on cost of capital as we speak right now. Interest costs have been trending upwards in most countries, most geographies we are operating in. But we are balancing these through a better business mix, through a better portfolio of products, and a conscious shift towards services, which though small at the moment, they are an important component of our go-forward strategy. So I think net-net, we expect the margins to stay similar this quarter too, and as we go forward, I think the global financial situation we will calibrate against that as we go forward. To your question on the on how much of our revenue comes from consumer versus other segments, we have a volume play, which is the work from home and learn from home, and then the volume devices, which are the PCs, notebooks, which also get into the SMBs, mid-markets, and the corporates. That segment of our business contributes 24% to the company's overall revenue. And our value segment is 15% growth right now, and cloud is about 67% growth right now. So I think if you combine cloud and value, we have a very significant portion. So the volume business growing 24% contribution to the company at about a third, and the value segment growing much faster than that, about 35% contribution to the company, a third. And our mobility is also about 36% overall contribution to the company. So I think all in all, I think we are sort of well represented and well hedged against through all the various segments that we operate in.
Good morning. So you don't have any pressure that's creeping in right now. There's a good growth, but you are exposed to a lot of regions where there are some challenges underway, right? Whether it's Middle East, Africa, Turkey, South Asia, across the board. Are you seeing any signs of caution?
We are, and I think we've calibrated ourselves with respect to exactly the kind of countries you are sort of mentioning, and we operate in a very unique mix of countries. Some of the countries are not so good right now. You mentioned those: Turkey, Nigeria, Kenya, Ghana, Egypt, and some of the other countries that we operate in, countries like UAE, Qatar, Saudi Arabia, India. All of those are extremely good. So net, I think the demand equation is balancing out for us in these between these two geographies. The financial equation is also balancing out between two geographies. We do exercise caution and abundant caution of making sure that we are hedged from a foreign currency perspective. We are hedged from a dollar. We can we can expatriate dollars from countries that are really going through a financial crisis right now, like Nigeria, for instance, and like Egypt as well. So we hedge those with the portfolio of really strong countries like UAE, Qatar, and India, and Saudi right now, and that is helping us to stay strong right now. So we see a very strong demand equation, which is balancing out. But some of the countries which are growing, they are growing much faster than we had anticipated earlier.
Rajiv, the net cash of the company is compared to what it was at the end of the second quarter last year has dropped quite a bit. Could the company get back into net debt? I mean, I think working capital days, etc., have also gone back. Could you go back into net debt from being a net cash company?
I think we expect our account receivables and our account payables to balance out in the short run. You're right. Our working capital has gone up from the COVID times. We are seeing two things pay out. I mean, like I said, account receivables, account payables balancing out. and there is a pressure of slight increase in inventory buildup. Our guidance to the street last quarter was that the working capital will settle between 27 and 35 days, which is higher than the pandemic times when you were stuck by COVID, but it is much lower than the pre-pandemic times, pre-COVID times. And I'm happy that our working capital in Q2 came right at the lower end of the guidance at 27 days. So working capital will go up. This is a capital intensive industry, but we have a good way of trying to make sure that it balances out with the demand that we are seeing in the markets, and we are always gravitating towards better products, better mix of business, like I said earlier, and we'll continue to do that. So we do expect working capital to settle between 27 to 35 days, which is much lower than, like I said, than the pre-COVID time.
Okay, working capital 27 to 35 days and margins maintained at these levels. We've got a couple of numbers out of you. Mr. Srivastava, you know, a couple of more details if we could squeeze in. You've grown by close to 25% in the first half of the year. By the end of this year, for FY23, what kind of a growth number should we work with? If you could give us a broad band. And also the other question is for the industry perspective itself, the chip shortage issue, the worst is behind?
Yeah, I think the chip shortage, the worst is behind for most categories of products. And you got to distribute the chip shortage into two kinds of products. In the PCs, servers, storage, and notebook devices, the chip shortage is behind us. We are getting adequate supplies. The linearity of supplies has been extremely, extremely healthy. And so we are able to demand fulfill for our customers on a regular and a continuous basis. The chip shortage, however, continues in the networking part of the equipment. And that's something which has been going on for a while. I expect that to continue for at least another 2 quarters. So hopefully when we get down to the early part of next year, I think the chip shortage will be completely out of our lives for pretty much every kind of equipment that we do. Now, what the networking chip shortage does is, if you have a project which is comprised of all kinds of equipment, which is network, storage, software, hardware, and servers as well, then you have a delay in execution of projects of that nature. So I think that's something which is playing out. But for large parts of our lives, chip shortage is out of the equation now.
30 seconds. Just trying to squeeze one more in. Apple revenues have been falling for 3-4 quarters in a row. When are those likely to reverse, in your opinion? Very briefly.
Look, I think Apple has been pretty steady in our overall mix, in our overall portfolio. While we've grown, Apple is at about 27% of our overall revenue. But Apple is very broad-based, and I really want you to register this, that Apple has got iPhones, and then they've got a whole range of computing equipment, which is Macs and pads, and then a whole range of accessories. So our portfolio with Apple also, within 27%, is very diverse, or very broad-based between Apple iPhone, which is about less than half of our overall Apple revenue. So we don't see any pressure on account of Apple revenues or shrinking or thing, because we've had a good growth on Apple. We've got our mobility growth this quarter has been 36%. So, and largely contributed by Apple and the launch that Apple had of the new iPhone range. So I think that's done fairly well for us. And to your earlier question about growth and how we see growth for the rest of the year, we've had a very healthy first half. We expect the momentum to continue in H2 as well. So we should continue to see a nice, good double-digit growth as we go forward into the next fiscal.
All right. Okay, we'll leave it at that. Thanks a lot for joining us. Double-digit growth is what they're looking at. But for the market, don't lose sight of what's happening. The Nifty has cooled off a little bit.